think we're almost past the peak pain for China. A lot of this now we think is in the price. There is now a risk premium being priced into Chinese equities. They've become rather unloved. Welcome to Key Points for September. This month you might see a few changes. I'm no longer in my little cupboard at home doing my shaky videos from the COVID era. I've got a fancy new production team here, so please leave comments where you think this is better or I should go back into my cupboard going forward. Now this month, what hasn't changed is our 3 points. The first one is around the Eurozone. Data, frankly, coming out there is really quite grim and a concern. We turn to China, where actually, although things are still problematic, there are some signs of stabilization, which gives us some cause for hope. And what about the financial markets as always? Well, equity is still grinding higher, but what's the future hold here? Is there likely to be a winter of discontent for equity investors ahead? So let's turn to our first point around the Eurozone. Now the Eurozone has been weak and feeble growth for some time now, but there's some things that are really quite concerning. If you look at the chart I've got here, you can see the blue line is a manufacturing sector. Anything below this dotted line here is contraction, you can see. And of course, we've been seeing a manufacturing contraction really on a global basis for some time. But look at the red line here. This is the service parts of the European economy. Now, we've all been going out on holiday, we've been eating out, we've been going to the cinema. That's been offsetting that manufacturing weakness. But hey, look what's happening now. Not only has this been declining, but even services are now in the contractionary territory as well. A real concern going forward. And for the ECB, that's the challenge. They've got an upcoming meeting in just a couple of weeks' time. What are they going to do? We think they should pause, just see the impact of these rates and what they've done over the summer period before deciding whether further rate hikes are needed. Currently, the market's about 50-50 in this because inflation, although it's coming down, wages are still quite high. We think they should pause, and that should be a good platform for them to make a next decision going forward. So let's now turn to our second point, and actually my favorite topic right now around China. We've said for a long time China faces many problems, whether it's around the shadow banking situation or the poor housing market, and even retail sales and consumption has been under pressure recently. But there are now signs that things are beginning to stabilize. The authorities are now providing much more targeted stimulus, but it's quite broad-based. Almost every day we're seeing new initiatives being announced, and that we suspect will lead to some kind of stabilization around the economy going forward. Now let's look at the chart I've got here, which is the Chinese stock market over the last 2 years. And frankly, it's been a pretty torrid time it's had. Whether it's intervention around the technology or the media names, you can see that investors have almost given up. But we think we're almost past the peak pain for China. A lot of this now we think is in the price. There is now a risk premium being priced into Chinese equities. They've become rather unloved. And this is at a time where actually earnings are growing and multiples are actually pretty low by historic standards, something you can't say about most other global stock markets. So turning to our third point around global equities. Well, while Chinese equities, I just said, were looking quite cheap, that cannot be said for the global equity market. Investors appear to be thinking the glass is very much not half full, but 3/4 full when it comes to global equities. And you can see that on the chart that I've got here. Since the start of the year, the MSCI World Equity Index has been up appreciably. The lines that I've got here are moving averages. They're not really all that scientific, but investors are humans and they tend to like to feel that there's some support levels around. And historically, these moving averages have offered some psychological reassurance to the investment community. You saw that at the start of the year where the 200-day moving average held. You see it around the 50-day moving average earlier in the summer. And most recently, you've seen the 100-day moving average give some support to investor psychology. Now, the question, of course, is can this continue? Well, frankly, momentum is still very strong, and therefore there's potential to move higher. But we suspect that this is going to fade because, as we've mentioned for a few times now, the fundamentals are still a challenge for these equity markets. And therefore, we think as we get into the autumn period and into the late or the early winter period, it's going to become more challenging for these investors going forward. So we suspect this could well be rolling over in the months ahead. Now remember, as always, you can read the full report on zurich.com/MSME, and we would love to hear from you in terms of challenging our views. Do you have a different opinion? Do you have some questions to ask? Please leave them all below, and we look forward to hearing from you and seeing you again next month.